So this week I wanted to provide a market update. There's a lot of things going on within the market. We've already seen a really tough start to almost halfway through the year. Stock market sitting down close to 15%. There's really not one particular sector that's been doing well other than energy, oil. So we want to take you through some interesting insights that we've seen and maybe unpack some of the things that's been going on within the economy. So we wanted to take you through a couple graphs that kind of illustrate this point. Again, some interesting observations that we've seen come about. First off, U.S. companies are still running really strong. So profit margins are still continuing to grow. You see this in the left graph where it's showing the increase in profit margins that are still operating at record highs. So that's a good piece of information. This means that even with the high inflation costs, U.S. companies continue to push on the additional costs onto consumers, and that essentially drives up revenue while still covering their higher costs. So in the end, inflation hasn't really hurt the U.S. company. If anything, it's hurt us, the U.S. consumer. You can also see on this right top graph that it's showing the labor share of income. And it's just meant to illustrate that companies are not only getting record profit margin, but they're also paying their employees at a higher rate than they have in the last 15 years. So it's an interesting dichotomy that usually those two work inversely, but right now as it stands, they're kind of going in lockstep. Speaking of consumers, let's take a look at some information about consumers in the US. So in these three graphs, the one I want you to focus on is the household debt service ratio. So back in 2007, 2008, the percentage of debt that people were paying off with their income was somewhere around 13%. Now that number in the last couple of years has really come down and fallen to something like 9%, and it's still around that range. And so it shows us that even though some things have gotten more expensive, consumers are really sitting in a nice position. They're not taking 13% of their income to pay off debt. They're taking something like 9% of their income to pay off and service debt. And this is further illustrated by this graph underneath that, which shows the flow of personal savings. So personal savings, again, has gotten a huge increase because of what happened through the COVID pandemic. We had to stop traveling. We had to stop taking those trips. And what does that mean? Less spending, more savings. So there's been a nice recovery in the savings rate attributed to the COVID pandemic. And of course, inflation is still on everyone's mind because it's still so high. So the Fed is trying aggressively to bring that number down. They don't want inflation to continue to go out of control, 8+%. Hopefully we get it to start to stabilize here in the near term and for the long term, because again, inflation is really what drives and hurts consumers, right? The idea that we have to pay more at the gas pump or more for groceries. And you can see that right here, that the energy CPI is the one that's definitely gone up the most at almost 26%. So again, think of those three different graphs that I showed. Number one, U.S. companies. U.S. companies are still in a very strong position, right? They're still growing their profit margins. They're still able to keep up with inflation by passing along the cost. Number two, consumer finances. Consumers are still in a very strong position as well. Some of those debt service ratios might start climbing if some people have adjustable rates, but most people refinance into lower rates. And so why would they be taking on adjustable rate knowing that sometime in the future rates were going to go up, which is exactly what's happening today. So consumers are still in a very strong position, it appears, across the board. So it still lends that we're not getting over exuberant. People aren't going off spending like crazy. They're still being conservative in their savings. And so that all bodes well for just the economy in general. And lastly, inflation, right? Inflation is the biggest thing that the Fed has talked about. Jerome Powell talks about it every time he gets up there. That's the big number that they're looking to bring down by raising the interest rates so that they can calm inflation and kind of bring on this easy inflation period where they don't have to worry about things getting out of control. So I think it's important to remember and always keep a perspective about where we sit today. So even though we're in this one period of time, this graph I like because it illustrates the annual year return for the S&P 500 along with the intra-year declines. So there's these gray bar graphs that show you, hey, the stock market for the year ended 23% up or 27% up. In some cases, it ended down, 23% down. And throughout the year, the stock market declined in a lot of those years that it ended really high. So, for example, in 2020, the market was down something like 34% sometime during the year. And then it actually ended the year at 16% up. So it's a nice illustration for us to keep perspective that we're in this period of volatility where things seem uneasy, they seem uncomfortable, because they are, because we've seen our accounts and our portfolios drop 15+%, and that's never fun to kind of live through and go through. But of course, when we talk about investing, we're talking about long term. We're not talking about short term. And we're really looking at that period in the last 5 months that we've been down 15%. If we look back over the last 10 plus years, we'd be sitting okay. So we want to make sure that we still have that in perspective, that we're taking on the long term view and that this is one period of time. So what can we do as advisors? What strategies can we implement? What strategies can we put into place? Now, the biggest one is we don't want to make any big decisions around investments. If we try and get out of the market and the market starts to recover, then we've lost, right? So we can never try and time when we're going to get in, when we're going to get out. We're going to take this easy approach to either dollar cost average throughout the next couple of months if we got money sitting on the sidelines, or remain how we're invested to ensure that as things recover, we're taking part in that recovery. But one of the bigger strategies that we can utilize, especially for people who have non-retirement accounts, is to realize capital losses. So if there are some positions in your portfolio that have some loss, if we realize some of those losses, we can offset either gains that we have this year or in the future. And that becomes a nice way for us to take some tax savings and either use them today or for the future. So that's one area that we're looking to harvest, is the capital loss in your portfolio. So be on the lookout for that. So there you have it. That's what we're seeing in the markets. It's not all doom and gloom, but there is a lot of doom and gloom around where we sit today in the stock market. So we may be headed towards more pain, especially in the future as volatility continues to ramp up. However, we remain committed to the long-term strategies that we have in place, especially for your financial plan. And so if that's something that's worrying to you, or you're not sure about what the future holds and what it looks like, give us a call. Let us know how we can help you and walk through that process with you about our strategy and how we include this as part of our analysis. So I hope you have a great weekend, and as always, take care.